How the wealthy invest before a market downturn. Write that down. Because right now, while you're scrolling on your phone watching some influencer tell you to buy the dip, there are people with real money quietly moving it somewhere else. They're not panicking. They're not waiting for a headline to tell them what to do. They already did it weeks ago, months ago, and by the time you and I hear about the crash on the news, the smart money is already positioned, already protected, and in a lot of cases, already buying the stuff that's about to get cheap. That's the game. That's how it's always worked. The rich don't get rich by reacting, they get rich by preparing. And I'm going to break down exactly what that prep looks like, step by step, no fluff, no jargon, just straight talk, because I've been broke, I've been rich, and I've watched both sides panic and both sides profit. The difference isn't luck, it's what you do before the storm, not during it. Before I get into it, I need you to do one thing for me. Hit subscribe right now. I'm not asking, I'm telling you. Because what I'm about to walk you through is the kind of stuff people pay financial advisors thousands of dollars a year to explain badly with a bunch of confusing terms. So you keep paying them. You're getting it for free. All I want in return is one click. Do that now, then keep watching. Let's start with the biggest myth out there. People think the wealthy are sitting around trying to predict when the crash is coming. They're not. Nobody knows when it's coming. Not me, not your uncle who called the last one, not the guy on TV with the charts. Anybody who tells you they know exactly when the next downturn hits is either lying to you or lying to themselves. What separates the wealthy isn't prediction, it's preparation. They operate like a crash could happen tomorrow, every single day, whether it does or not. That's the mindset shift you need to make right now, today, before you watch one more second of this video. Here's what that looks like in real life. Wealthy investors almost always keep a chunk of cash on hand, not because cash is a great investment. It's not. Inflation eats it alive over time, but because cash is optionality. Cash is a weapon when markets crash and stocks go on sale. The person with cash in hand can buy. The person who's fully invested, who puts every dollar to work chasing returns, can't. They're stuck watching from the sidelines, or worse, they're forced to sell something at a loss just to cover a bill or a margin call. You never want to be that person. You never want to be forced to sell. Forced selling is how regular people lose money in a downturn. And forced buying opportunity is how wealthy people make it. Think about it like this. If you're a business owner and a competitor's shop goes up for sale at half price because they couldn't survive a rough year, you can only buy it if you got the cash sitting there ready to move. Same thing with stocks, with real estate, with anything. The wealthy keep dry powder. That's the term you'll hear. Dry powder sitting on the side specifically. So when everyone else is scared and selling, they've got ammunition to buy. It's not about timing the exact bottom. Nobody hits the exact bottom. It's about having the ability to act when the opportunity shows up instead of scrambling to find money you don't have. And here's the part most people get wrong. They think building that cash cushion means stopping their investing completely. It doesn't. It means being deliberate as they make money, as their portfolio grows. A piece of every gain gets peeled off and set aside. Not all of it, but enough that when the music stops, they're not the one without a chair. That discipline, doing it every single month, every single quarter, regardless of how good things feel, that's the boring, unsexy habit that separates people who survive downturns from people who get wiped out by them. Nobody makes a YouTube video bragging about their cash position when the market's ripping higher. But I promise you, the people who stayed rich through multiple recessions all had one. One more thing about this cash position that people never talk about. It's not just about having money ready to buy stocks or businesses when they go on sale. It's about peace of mind. And peace of mind is worth more than people give it credit for. When you've got a solid cash cushion sitting there, you sleep better. You don't check your phone every 5 minutes during a crash. You don't make dumb emotional decisions because you're scared about paying your mortgage next month. The wealthy aren't immune to fear. Nobody is. But they've removed one of the biggest triggers of panic selling, which is desperation. Desperate people make terrible investors. Prepared people make great ones. That's not a coincidence. That's cause and effect. Now let's talk about where the wealthy actually put their money when they're bracing for a downturn. Because cash isn't the only move. Historically, one of the first places big money flows is into hard assets, and the biggest one of those is gold. I want to walk you through why, because it's not complicated once you understand it. When people get nervous about the economy, about the dollar, about inflation, about the government's ability to handle its debt, they go looking for something that can't be printed, can't be inflated away, and has held value for literally thousands of years. That's gold. It's not flashy, it doesn't pay you a dividend, it just sits there. But that's exactly the point. In every major downturn in modern history, the pandemic crash, the 2008 financial crisis, the dot-com bust, gold held up or went up while stocks were getting crushed. It's not a coincidence. When confidence in paper assets drops, confidence in something physical, something you can hold, goes up. Now I'm going to be straight with you, because I don't sugarcoat things. Gold has been on an absolute tear recently, and that should make you a little cautious, not excited, when everybody and their cousin is suddenly a gold expert. When gold prices are breaking records, even when we're not in a recession, that tells you people are already nervous about something. Maybe the dollar, maybe the debt, maybe all of it. That's useful information. But it also means gold isn't some magic asset that only goes up. It goes up when fear goes up. If that fear fades, gold can come right back down. I've owned physical gold for years, long before it was trendy. Not because I think it's going to make me rich, but because it's insurance. You don't buy insurance hoping to use it. You buy it so you're covered if things go bad. This is where the wealthy think differently than the average investor. They're not looking for gold or real estate or any hard asset to be their big winner. They're using it to balance out risk somewhere else in the portfolio. If your stocks are getting hammered, having a piece of your money in something that tends to move the opposite direction gives you stability. It's not about maximizing returns in the good times. It's about not getting wiped out in the bad times. So you're still in the game when the good times come back around. A lot of people blow themselves up chasing the highest return instead of protecting what they've already built. Don't be that person. Real estate plays a similar role for a lot of wealthy investors, especially income-producing real estate. People still need a place to live, and businesses still need a place to operate. Recession or not, rental income tends to be more stable than stock prices, which swing wildly on emotion and headlines. That doesn't mean real estate is risk-free. It's not, and it's a lot less liquid than stocks, meaning you can't just sell it in 5 seconds if you need cash, but owning something tangible, something producing income no matter what the stock ticker says that day, is a core piece of how wealthy people build a floor under their net worth before things get rocky. Next, let's talk about something most people completely misunderstand, and that's treasuries, basically loans you make to the United States government. On paper, treasuries are a bad investment. I mean that the returns are usually low, historically lower than stocks, lower than real estate, lower than a lot of things. So why do wealthy investors pile into them right before or during a downturn? Simple safety. When markets get scary, when people don't know what's coming next, they will trade potential upside for certainty. And the US government, whatever you think about the debt, whatever you think about Washington, has never missed a payment. That track record matters when everything else feels shaky. Here's how it actually plays out historically. In every major crash we've studied, the pandemic, the housing crisis, the dot-com bust, money flooded into treasuries while stocks were getting crushed. Prices on those bonds went up because demand went up. People wanted the safest thing available, and the government was it. That's not a coincidence. That's herd behavior. And wealthy investors know herd behavior is predictable, even if the timing isn't. When fear spikes, money runs to safety, and treasuries are one of the biggest beneficiaries of that fear. But I want you to think a little deeper than the average person here, because this is where it gets interesting. Wealthy investors don't put money into treasuries because they think it's a great long-term investment. They put money there because it's a parking spot, a safe place to sit while the storm passes, so they can redeploy that money into something better once prices crash and opportunities show up. It's not a destination, it's a waiting room. You wait there with your money protected, you watch what's happening. And when stocks, real estate, or businesses get cheap enough, you move. I also want to point out something people miss about treasuries, and that's the timeline. Not all treasuries are the same. Some are short-term, maturing in a matter of months. Others stretch out 20 years or more. Wealthy investors pay attention to that difference because longer-term treasuries tend to move a lot more when fear spikes, sometimes gaining big percentages during a real crisis, while shorter-term ones barely move at all but give you almost instant access to your cash if you need it. It's not about picking one and forgetting about it. It's about understanding the different tools inside that same safety category serve different purposes and knowing which one fits what you're trying to accomplish. Now, I'd be lying to you if I said treasuries were bulletproof. There's more concern today than there's been in a long time about the size of the national debt, about the strength of the dollar, about whether the government's promises are worth what they used to be. That's a real conversation happening right now among serious investors, not just internet doom and gloom accounts. But here's the thing, even with all that noise, the United States is still the largest economy in the world, the dollar is still the world's reserve currency, and when the entire globe gets scared, money still runs toward America, not away from it. That could change over time, and smart investors are watching it closely. But right now, treasuries still play their role as the safety net and wealthy people lean on before things get ugly. The next move separates people who just survive a downturn from people who actually build wealth from one. And it's this: while everyone else is panicking and selling, the wealthy are buying, not randomly, not blindly throwing darts, but buying real value, real businesses, real companies with real cash flow at prices that make no sense. To ignore this is the single biggest wealth transfer mechanism in the entire economy. And it happens over and over again, every single downturn, because most people's emotions work against them at exactly the wrong time. Think about how the average person behaves when the market drops 15, 20, 30%. They panic, they see their account balance shrink, and their gut tells them to get out before it gets worse. That's human nature. That's how we're wired. Our brains treat a falling stock account the same way they treat physical danger. But the wealthy, the ones who actually build generational money, have trained themselves or hired people to do the opposite. They see a great company on sale, not a falling stock to run from. Same company, same products, same customers, same long-term value, just a cheaper price tag because everyone else got scared. This is exactly why every major recession in history has created a wave of new millionaires, more millionaires than almost any other period in the economy. It's not because those people were smarter than everybody. And else, a lot of the time, it's because they simply had the cash ready, the patience to hold, and the discipline to buy when their gut was screaming at them to sell. That's it. That's the whole secret. And it's frustratingly simple, which is exactly why most people never do it. It's easy to say, buy low, sell high. It's brutally hard to actually do it when your account is bleeding red and the news is telling you the world is ending. This is also where owning individual pieces of great businesses versus owning a broad basket matters. Some wealthy investors go hunting for specific companies, ones with strong balance sheets, low debt, real profit margins, businesses that aren't going anywhere even if the economy slows down. Others prefer spreading that risk across a fund that holds dozens or hundreds of companies at once, so no single bad pick sinks them. There's no one right answer here. It depends on how much research you're willing to put in and how much risk you're comfortable carrying. But the underlying principle is identical either way. Downturns are when quality goes on sale, and the people who show up with cash and confidence during the sale are the ones who walk away wealthier on the other side. Here's something else worth understanding, because it explains why the same 3 or 4 categories tend to show up over and over again across different recessions, even though the cause of each recession is completely different. In 2020, it was a pandemic. In 2008, there was a housing collapse. In 2000, it was the internet bubble bursting. 3 completely different triggers, 3 completely different economic environments. But look closely, and you'll see certain things show up almost every single time because human behavior during fear doesn't really change, even when the circumstances do. People want safety, they want necessities, and they want to protect what they have. That's true whether the crisis is a virus, a housing crash, or overhyped tech stocks. What's actually different each time is which specific industries catch a bid based on the unique nature of that particular crisis. During the pandemic, healthcare and work-from-home companies took off because it's literally what the moment demanded. During 2008, technology started to become the next big growth story because the internet was still young and undervalued. During the dot-com crash, defense stocks and discount retailers saw a boost because of the specific events happening at that time, including geopolitical conflict. The lesson here isn't to memorize a list of tickers. It's to understand that whatever causes the next downturn, and right now there's real concern about an AI bubble, concerns about the dollar, concerns about basically every asset class being overpriced at the same time. That specific cause is going to determine which industries benefit most. Pay attention to what's actually breaking the market. Not just that the market is breaking, I also want you to notice something about which industries tend to hold up or even benefit during tough times, because it's not random. Companies that sell things people need no matter what, groceries, household basics, everyday essentials, tend to keep making money in good times and bad. People don't stop buying soap and toothpaste because the stock market dropped. Those companies keep generating cash, keep paying their bills, and in a lot of cases, keep paying dividends to their shareholders straight through the storm. That stability is exactly what nervous money goes looking for, and wealthy investors know it. So they lean into those businesses when uncertainty rises. The last piece of this puzzle isn't a stock, a bond, or an asset at all. It's mindset. And honestly, it might be the most important one on this entire list. The wealthy control their emotions, or at the very least, they built systems so their emotions can't sabotage their decisions. That's the real edge. Not some secret stock pick, not some insider information, just the discipline to stick to a plan when everybody around you is losing their mind. Here's what I mean. Most people don't actually have an investment plan. They have a collection of decisions made in the moment based on how they feel that day, based on whatever headline scared them that morning. That's not a strategy. That's gambling with extra steps. Wealthy investors, the ones who consistently come out ahead across multiple decades and multiple recessions, decide their strategy in advance. When things are calm, when they're thinking clearly, not in the middle of a crisis, when adrenaline is running the show, they decide ahead of time how much cash they'll hold, how they'll rebalance, what they'll buy if prices drop a certain amount. Then when the chaos hits, they're not making decisions. They're executing a plan they already trust. This matters because your brain during a crash is not your friend. Fear does something to your thinking. It shrinks your time horizon down to right now, today, this week. When investing has always rewarded people who think in years and decades, the person checking their portfolio every hour during a crash is far more likely to sell at the bottom out of pure panic than the person who built a plan, automated as much of it as possible, and simply let it run. I've watched brilliant people way smarter than me on paper, blow up their portfolios because they couldn't control their emotions in the moment. And I've watched regular, ordinary people build serious wealth simply because they had a boring, repeatable plan and the discipline to stick with it when it got uncomfortable. The wealthy also understand something a lot of people miss, and that's the difference between risk and uncertainty. Uncertainty is not knowing what's going to happen. And nobody, I don't care who they are, can eliminate that. Risk is what happens to you if you're wrong. And that part you can absolutely control by keeping cash on hand, by diversifying into hard assets, by not over-leveraging themselves, by having a plan before the storm hits. Wealthy investors aren't trying to predict the future. They're making sure that whatever happens, they can survive it and more than survive it. Come out stronger on the other side. That's the whole game. Not being right about when the crash comes, being ready for it regardless. So here's your challenge. I don't want you to just watch this video and move on with your day like you do with every other piece of content on the internet. I want you to actually go look at your own situation right now and today. Do you have any cash set aside, or is every single dollar you have tied up somewhere where you can't touch it if an opportunity showed up tomorrow? Are you diversified at all, or is it all just one bet in one direction? Do you actually have a plan for what you'll do if the market drops 20%? Or are you planning to just figure it out at the moment, which we now know is exactly how people lose the most money? Write down one thing, just one, that you're going to change this week based on what you just learned. Not next month, not eventually, this week. The wealthy didn't get that way by knowing more than everybody else. A lot of the time, they simply prepared while everybody else waited. If this video gives you real value, subscribe, share it with somebody who needs to hear it, and I'll see you in the next one.